Hey everyone, welcome back to Corporate Decoder, the place where we will be looking at Nuveen's latest SEC filing, and let me tell you, it is a lengthy one packed with details that might make your head spin unless you got us here to break it down for you. This filing reveals the financial health and strategic moves of the Nuveen Credit Strategies Income Fund and its siblings over the past year, so buckle up because we are going deep into fund performance leverage and what it all means. For investors, before we dig into the nitty-gritty, I want to give a quick shout out to our Discord community. It's the best place to connect with fellow corporate finance enthusiasts, share insights, and get your questions answered. The link is in the description below, and you should definitely check it out. Now, let me tell you, this report is a dense read, but we are going to focus on the most interesting parts: the numbers, the risks, and the story they tell. Let's start by looking at how these funds are actually making money or losing it. This section is crucial because it tells us about the core operations beyond just trading stocks and bonds. For the fiscal year ending the 31st of July 2025, we see some interesting figures. Nuveen Floating Rate Income Fund, or JFR, brought in over $110 million in net investment. That is a solid number indicating good income generation, but it's important to remember this is after expenses. Now, Nuveen Credit Strategies Income Fund, or JQC, is not too far behind with over $66 million in net investment income, while Nuveen Preferred and Income Opportunities Fund, or JPC, is making a huge splash with nearly $149 million, which is quite impressive considering the market conditions. But income is only part of the story. When you look at realized gains and losses, it's like looking at how well the fund managers are making smart bets and cashing out. For JPC, we see a significant realized gain of over $41 million. That is a big win for them, beating their benchmark hands down and showing some real skill in capitalizing on market movements. JQR, on the other hand, had a realized loss of over $14 million, which is a tough pill to swallow even for a credit strategy fund that often deals with risk. I mean, losing $14 million is a lot of money, and it suggests some of their bets did not pay off as expected. JFR also saw a realized loss of over $25 million, which is quite substantial for a fund focused on floating rate income. This suggests that some of their strategic decisions in managing interest rate risk might not have worked out as planned in the past year. Now let's talk about the value of the investments themselves. Even if they haven't been sold yet, it's essentially a look at how the market is currently valuing the funds. Holdings JPC saw a massive increase in its unrealized appreciation, over $62 million. This is fantastic news, showing that the market is currently valuing their holdings higher than when they bought them. JQI and NPFD also saw substantial unrealized gain, over $11 million and $28 million respectively, which is positive for those funds. However, JFR experienced a pretty significant unrealized appreciation of nearly $16 million, and JQC also saw a drop in unrealized value of over $3 million. This means their current holdings are worth less than when they were acquired, and while this can be temporary, it does signal some market pressures on those specific funds. Taking all of that together, the net increase or decrease in net assets applicable to common shares from operations gives us the bottom line for JPC. That is a phenomenal almost $252 million increase. That is a huge jump and shows they had a great year overall. JQI and NPFD also had positive gains of over $28 million and $46 million respectively. But JFR and JQC took a hit. JFR saw a decrease of nearly $7 million, while JQC had a decrease of over $2 million. This highlights that while some funds within the Nuveen family are thriving, others are facing headwinds. Now let's talk about how these funds are raising money. They had some interesting capital raising activities. JFR and JQC both had rights offerings. This is basically like giving existing shareholders the chance to buy more shares, often at a discount. JFR raised over $220 million through its rights offering, and JQC brought in about $62 million through theirs. This is a classic way for closed end funds to grow their asset base and potentially increase management fees, given the fee structure is often based on assets under management. JPC was quite active here, selling over 6 million shares through its shelf offering, raising nearly $54.5 million. That is a significant amount of capital injection into the fund and shows confidence from the market, or at least from those buying at a premium to NAV. JPI went the opposite direction though, engaging in a tender offer to repurchase shares, effectively buying back its own stock from shareholders and retiring them. This actually reduced their share count by over 8 million shares and cost them around $173 million. It sounds dramatic, but this can be a strategy to boost NAV. per hair's hair if the stock is trading at a discount. Now, for the part that directly impacts your wallet, how much are these funds costing you? The management fees column is key here. We see JPC charging 1.21%, JQI a bit more at 1.32%, and JFR at 1.22%. These might seem small, but on billions of dollars they add up fast. But the real cost drivers for these funds are in the interest and other related expenses. JFR is paying a whopping 3.37% of its assets. Just on leverage and interest costs, JQC is right behind at 3.53%. And JPC is also heavily leveraged at 3.39%. This shows how much these companies rely on borrowed money to juice their returns and when interest rates rise. As we know, they have these costs can skyrocket. This is a critical risk for them because if their investment returns don't outpace their borrowing costs, they could be in serious trouble. Looking at JPC's borrowings is popping they have over $649 million in borrowings. That is a massive amount of debt reflecting their aggressive use of leverage to chase those higher returns in JPI, while smaller is still borrowing over $118 million. It is clear these funds are playing with borrowed money in a big way. This is where things get really interesting. The effective leverage. Numbers are crucial. JFR has an effective leverage of over 36%. JQC is at 37%. JPC is right there too at 37%. And NPFD is at 36%. This means a significant chunk of their investments are financed by borrowed money or other forms of leverage. This is a double. Edged sword, it amplifies gains when things go well, but boy does it amplify losses when things go south analysis. So what is the overall story here? Nuveen. It's closed. N funds, especially those in the credit and preferred securities space, are highly leveraged operations. JPC had a standout year with strong net investment income and a huge boost from unrealized gains, while some others like JQC and JFR are grappling with realized losses and market pressures. The heavy reliance on leverage, particularly through borrowings and preferred shares, is a major theme. It's what allows them to aim for that high current income. But it also amplifies risk, especially in a rising interest rate environment. The fact that JPC, JPI, and NPFD are heavily concentrated in financial services companies also presents a significant sector. Specific risk given the current regulatory and economic climate around banks. However, their ability to raise capital through rights offerings and shelf programs indicates investor appetite. Remains strong at least for now. The sheer volume of preferred securities and debt instruments held shows a clear strategy focused on generating income, but investors need to be aware of the substantial leverage and credit risks involved. This is not for the faint of heart. What is my take? Well, JPC. Numbers this year are impressive, driven by strong gains, but the leverage, especially in JPC, JFR, and JQC, remains the elephant in the room as interest expense. EAs are a huge drag on their performance. The risk is that if interest rates stay high or if their investments suffer significant losses, the amplified losses from leverage could be devastating on the flip side. If interest rates come down and their leverage bets pay off, they could see even better returns. The portfolio manager changes are noted, but the core strategy of leveraged income generation remains. The principal risks listed are extensive and cover a wide range of market and credit events, which is standard for these types of funds, but the leverage is what really amplifies them for shareholders. It is a high risk, high reward game they are playing, and while JPC had a great year, the others are facing more challenging headwinds. Investors in these funds should understand the leverage implications very well. What do you think about these numbers and the risks involved? Let me know in the comments below. If you found this breakdown useful, give this video a like and subscribe to Corporate Decoder for more deep dives into corporate finance. And as always, check out the Discord link in the description to continue the conversation. I'll see you in the next video.